Tom Bowley, Chief Market Strategist here at Earnings Beats. Hey, good morning, everybody, and welcome to this Tuesday, July 16th, 2024 edition of Trading Places Live. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes or so as we prepare for yet another trading day. We are now into the middle part of July. We've got earnings starting to come in. We've had already a few big banks report pretty nice earnings. You can add Bank of America to that list this morning. Bank of America posting pretty good numbers. I was just getting ready to take a look at what kind of reaction we got, because you never know about the reaction. Bank of America up about 0.5% to at least here in pre-market action. But this is a company, a stock, a chart. It's been going straight up for a while. So I wouldn't be surprised maybe if we get a little selling. We saw that last Friday with both JP Morgan, which gapped down after posting great numbers, and then Citigroup, which gapped up but then sold off intraday before trying to come back a little bit. So sometimes you get the sell on the news, which I wouldn't be surprised in this case with Bank of America, because it has made a pretty good move up. But it has been a really nice performer on a relative basis. So I'm not surprised by its pretty good results that it posted this morning. The earnings really going to start to continue to roll in here as we go through the rest of this week and into next week. It's a lot of the Dow components, a lot of the really big companies report usually in the first week or two, and then we'll start seeing more and more of some of the second tier companies start to report, and that's when we'll get a lot of the names on the NASDAQ 100. We do have Netflix reporting this week. That's a big one. On Friday, we'll have American Express. I think that Netflix is either out later today or tomorrow, but let me see if it is scheduled for, my bad, actually scheduled for Thursday at the close. And then, of course, we have Friday morning American Express reporting, and I think they're going to have another big report there, just because many of the financials, you can see the XLF just breaking out. We'll take a look at that chart in just a few minutes. But we've got some things that have been happening that suggest that we're going to get some pretty good reports in some of these areas, and we'll talk about that more. This Friday, we've got options expiring. So, the excitement and the volatility never seems to cease. But with that volatility, or with that Friday announcement, with the earnings of American Express, and then having and then of course the reaction to Netflix, but then also having options expire on Friday, we could be in for some volatility a little bit later in this week. Volatility did rise yesterday. It's back up a little bit above 13, even though the market continued to move higher. That would bother me if the market keeps going up and the volatility keeps going up with it, and if it lasts for several days. So far, I'm okay with the volatility rising a little bit. It's still down in very, very low territory, which is good for equities. But it is at least one other thing to maybe keep in mind, is kind of watching to see, because normally when you get higher prices, the market volatility drops. And so anytime we see the two going hand in hand, it's just telling me that the market's getting a little bit more nervous, maybe won't handle bad news very well if we were to get any bad news. So it's something I always watch, because if you get positive correlation between the S&P 500 and the VIX over an extended period of time, it can mark a short-term reversal in the market. And of course, we've been going up. So a reversal would mean a downward price action. Trying to think if there's anything else before we get into the charts. Of course, we have the Fed meeting coming up at the end of this month. I think without a doubt, the Fed should cut rates at this meeting. I think the signals that the stock market is sending to the Fed, the signals that the bond market, and I'm usually more interested in what the bond market's doing, but the bond market has been absolutely sending the Fed a message that it's time to cut. This morning, we opened on the 10-year Treasury yield back down at 417, actually 417 and a half. Got down to 417. We're back up right now to 420. But that 417 level was as low as we've been over the course of about the last 4 months. So with the yields dropping, that means a lot of folks are getting into bonds. You don't do that if you fear inflation. So what I think a lot of folks are thinking is that they would rather, be and have the safety of the of bonds right now and wait and see what the Fed's going to do. I think if the Fed lowers, I mean, there's still a chance we escape with a soft landing, and of course that would mean that we killed off inflation, but we didn't ruin the economy. So the GDP stays positive, and that's kind of nirvana for equities if we can pull it off. I think we still have the chance to pull it off, but I think the longer the Fed waits, the less the chance. It could be nirvana if the Fed were to start cutting now. I think the market could still have another pretty significant run. I still think we're going to have a pullback later in the third quarter, but I think that pullback could be minimized if we can see some downward action on rates by the Fed, and then also see that rate decline start to have some impact over the next couple of months. Usually rate decreases takes a little while for their effect to take hold. So I don't know. We'll kind of play it by ear and kind of watch that and see how the Fed does. The Fed did say yesterday, they clarified, quote unquote, that they're not waiting for inflation to drop to 2% before they start cutting. So that was some good news. I mean, after all, they've been talking for the last 2 years about not needing to wait to 2%. At first they just wanted to see the CPI start to move lower, the core CPI. And then they wanted a period of, multiple declines so that they could feel like we're really heading toward 2%. Now we're sitting at 3.3 or 3.2% on the 1 year rate of annual inflation, the core rate. And we're still talking about this moving toward the 2% level. We were at 6.7. I mean, I'd actually love to get on a call with Fed Chief Powell and just kind of go back over what he has said over the last 2 years and to help explain to me why they're not cutting yet. It makes no sense. The only reason rates went up was because of inflation. So it just seems like a no-brainer common sense that when you no longer have inflation problems, which I would argue with anyone right now looking at forget about the fact that everything's higher than what it was a year ago. Prices don't go back to what they were. Inflation, when we talk about it moving back down to 2%, it doesn't mean that prices come back down. Prices continue going up, but they start to go up slower. And I can show you a chart. It's been doing this for almost 3 years now. So I think it's time, pal. Let's go. Cut rates. Anyway, we'll see if they do it. I have a feeling what they're going to do is start to talk about cutting rates more and less about raising rates, and try to get everybody feeling on, give them all the warm and fuzzies about, hey, we're going to cut rates. It's going to happen. We think it might happen in September. That's kind of what I expect him to say. And I hope that that's not too late. That's all I'm going to say on that subject. I think if they wait until September, the swoon that I see later this quarter is going to be deeper. I think it's already probably going to be deeper than what I had thought earlier in the year. But we'll see. We'll kind of play it by ear, listen to what they have to say, look at the market, rotation, and check out sentiment. The VIX is important to watch. The 5-day moving average of the equity only put call ratio the other day hit 0.54. And that is a reading that is consistent with short-term market tops. So I don't know. One last thing before we look at the charts. Retail sales came in this morning, so I did forget about that. So retail sales came in for the month of June, and they were better than expected. But the expectation is that they were going to drop 0.3%, and they were actually flat. So when you look at the last two readings, where I think we've been flat and then down 1%, now we throw another June reading on there, a flat. You can see that the economy isn't exactly flying here. Until last Thursday, we saw initial jobless claims rising. We've been watching the unemployment rate rising, and there's a whole host of economic reports that are starting to paint a little bit bleaker picture for equities, as I said, later in the quarter. So right now, I think we're okay. I think other than maybe the short-term sentiment indicator that says maybe we're going to top and maybe we're going to go sideways for a little bit. Outside of that, I think we're okay in the near term. We got some earnings. I think the earnings are going to be good. And then from there, we'll see what happens. We also do have one bearish period coming up, one of the worst bearish periods of the year. It begins tomorrow at the close and lasts for roughly 1 week. And that's coming in just as we're getting close to option expiration. So even though I think we go higher, maybe it goes on pause for a little bit, and then maybe we rise into the latter part of July, early August. But I'm not looking for anything horrible right now. But I do think in the next month or two, things could start to get really dicey. But we'll keep you posted on that. All right, let's take a look at the market action. I'm just going to go over the overview here on the dashboard, your dashboard page at Stock Charts, and zero in here, just kind of take a look at some of these numbers. Dow Jones yesterday finished up 211 points. That was up 0.5%. S&P, you can see, was up less, up a little bit more than the quarter of percent, but we did close at 5631.22. So clearly still back above that 5600 with 5700 in our sights now. The NASDAQ, I like to follow the NASDAQ 100 down here toward the bottom, rising 55 points. That was also up about 0.25%. But I want you to check out the small caps. Small caps really starting to catch fire here. This is something I was calling for maybe a little bit earlier in the year. I thought we'd have probably by the second quarter, I thought small caps would be taken off. But as Fed Chief Powell delayed the inevitable of these rate cuts and started talking about higher rates for longer, that kind of put the small cap rally on pause. But now that we're starting to see more and more signals that are telling the Fed, not actually requesting or hoping that the Fed starts to cut, but basically they are demanding a rate cut. That's what I'm seeing in the market. That's the story the market is telling me, is that both the bond and stock markets are demanding that the Fed cut rates, and they need to cut them now. We're going to see, what happens. I'm just, telling you what I see. Then, then it's a whole different story sometimes when I have to listen to the Fed and what they come up with. But anyway, that's the big difference. And so I think the Fed is kind of on the clock as to how bad things get over the next month or two, in my opinion. So we'll see what they have to say and how the market reacts to it. But that'll be coming up in 2 weeks. So I think it's 2 weeks from today that the meeting starts. I think it's the 30th and 31st. So it's a 2-day meeting. So we'll have the announcement 2 weeks from tomorrow. Anyhow, let's zero back out, come over here and take a look at the sectors. So you can see what happened yesterday in terms of the sectors. Energy, pretty big day, along with the financials. Financials have been on a roll. This is a group that I think talked about this a little bit last night in the model ETF portfolio draft event that we had. Talked about financials really coming to life here, breaking out. I see the banks. Once rates start moving down, I think it's going to be a very positive thing for banks, especially those small and regional banks. That area has really taken off here over the past 4 or 5 days. But those are two key areas. Saw a little bit of strength there in the industrials as well. But the action yesterday was mixed. It wasn't all to the upside. And you can see technology was pretty flat, but we had consumer discretionary down. We had healthcare, which has a little bit of their industry groups are more aggressive, but that was down. Communication services was more toward the flat line, even though it was up. So we just didn't get those aggressive stocks really firmly behind the rally. And that's kind of been the case over the past 4 days or so. So we're seeing this rotation. I think technology is still okay, and I expect the XLK to go higher from here. I just don't know that it's going to go a lot higher until we see a return to leadership in semiconductors. And that group, we're not seeing it. If we pull up the technology group and then zero in here on the industry groups from yesterday, you can see semiconductors were down again, really struggling to make any progress in the semiconductors. I mean, we were rebounding, then we took another pretty big hit, and now we seem to be downtrending again in that semiconductor space, even though the S&P keeps going up to new highs. So again, it's telling me the same story it's been telling me for the last week or so, really for the last 3 weeks, going back maybe 3.5 weeks to when semiconductors first had that big drop and had that bearish engulfing candle. But the message it's sending is that semiconductors, hey, thank you for your leadership for earlier in 2024, throughout 2024. Thank you for all you've done for the last couple of years. But we're going to have you take a rest for a little while and let that money rotate into other areas of the market. And that's what we've been seeing. So, I mean, if we go back, I don't know, maybe a month, you can see that the semiconductors have been flat. Look at all the other areas within technology. I mean, the only reason that technology is not getting killed is that the money that's rotated away from semiconductors is certainly finding a home in other places. Look at Apple, computer hardware. Apple seems to be setting all-time highs every day. Then you've got computer services, electronic equipment, very strong over the last handful of days. I don't know if you can see that chart there that pops up, but hopefully you can. But we just pushed through 1150. A week ago, we were down about 1080. So this is a group that's had a huge move to the upside. Electronic equipment, telecom, software we've talked about. Software's kind of been hanging, pulled back here recently. I still think we're going to see some more leadership there. But you can see since the beginning of June, software's had this huge move up, and it's seen some profit taking of late. But I expect that to move right back to the upside. So there are other areas in technology that I think will help us. And that's, if technology doesn't have a huge sell-off, that's 32% of the S&P 500. So even if semiconductors go down, if we continue to see this rotation that where money rotates into other areas of technology, it's going to help to prop up the group, the entire sector, even though, the semis, which have provided so much leadership over the last, few years, really throughout this entire secular bull market, it's allowing semiconductors to rest for a little bit. All right, 10-year Treasury yield. Let's take a quick look here. And this actually get an update here, make sure I got the latest. And then come over and you can see we're sitting just below 420 right now, 419.6. So back off the highs of the day, we got up to almost 422. Now we're back down just a little bit below 420. The low of the day was around 417. I mean, I don't know what you see on your chart, but over the last 2 weeks, I'm seeing the 10-year Treasury yield take a pretty big drop, similar to the drop that we saw after, we had a lower high in place from the April high. Big drop from there, rebounded, big drop, came back. We rebounded end of June, early July, and then the big drop. And now we're breaking to new lows. Again, I think the bond market's sending the Fed a pretty clear message that, okay, it's time. It's time. Stop talking about it. Let's do something. S&P 500 continuing to move up. The negative divergence that was on the daily chart looks to me like it's gone. Looks like we've got new highs. And so once again, this is a perfect illustration why you don't jump in as soon as you first see a negative divergence. A lot of technicians, that's exactly what they do. As soon as we see a negative divergence appear, they're like, okay, slowing momentum, rally's over. That's premature. It's too early. You need to see something else to corroborate it. Yes, it is a sign, but anytime the market, after an extended run, anytime the stock market simply goes sideways or pulls back a little bit, you're going to see that PPO drop. I mean, that's just the way the mathematical formula works. You need some corroborating evidence. When you make that breakout, you need a reversing candle. You need money on the breakout starting to move toward defensive areas as opposed to aggressive areas. Instead, what we're seeing is a lot of money rotating over to like financial stocks, industrials starting a little bit more, transport, small caps. I mean, we're starting to see this bull market simply spread its wings. That's what's happening. Those who always keep calling for negative divergences and breadth issues, I mean, I don't know how you trade the market. I mean, I'll just leave it at that. NASDAQ 100. NASDAQ 100 had broken out with a negative divergence. Now we've got equal highs on the PPO, still trending above the 20-day, still above the most recent breakout level. There's really nothing that has confirmed anything about a negative divergence. And like I said, I mean, now it's almost to the point where the negative divergence here is gone as well. AD lines continue to be strong. That would be something I would be worrying about if we had a big tumble in the AD lines, but we're not seeing that. And here's the IWM. This is what I had been talking about earlier in the year that I was expecting. Yes, it was disappointing. It was very similar, if you remember, to back in 2022 when I called a market bottom in middle of June. We took off. It looked like things were going. And then all of a sudden we went back down and had one more low in October. And what did we do after October? Market took off. So I was calling for a V bottom back in 2022, but really it went down throughout the year in 2022 when we started coming up in 2023. It's hard to get the timing exact. I mean, that's setting the bar really high for any analyst. But, you know, I'm starting to feel somewhat, you know, validated, redeemed, whatever, by the action that we're seeing in the IWM right now. Because in my opinion, when rates start to come down, and that's what I talked about at the beginning of the year, I thought the rates already would have been coming down. They should have already been coming down. Once again, Powell and his crew are a little bit late to the party. That's what happened when they, you know, didn't want to raise. And, you know, to be fair to the Fed, I actually agreed with them when they weren't raising for a while. And they probably raised too much, in my opinion. But back when they were, you know, saying it was transitory issue, I thought it was a transitory issue. So I'll take blame there too. I mean, I was right on board with the Fed and thought what they were doing there was appropriate. But this time I didn't agree with them. I think the evidence has been there for months that inflation is returning back to the level, and I think they've waited too long to lower rates. But this is one of those signals, again, where the stock market is screaming to the Fed that, hey, you have no choice. You've got to cut rates now. And as a result of that, Wall Street is pouring into small caps. Let me show you the KRE, which is the banking area, is one of the largest area of small caps along with the biotechs. But look at the KRE all of a sudden the last 5 days. I mean, this has been the best rally that we've seen since back in November, December period. After going sideways, really not doing much for months, waiting on the Fed to finally pull the trigger. Well, Wall Street's pulling the trigger for the Fed, basically, and saying, we're jumping in. We're getting in. You can see the volume going in. This has been, you know, I've been telling members and actually all of you as well, need to see that breakout above that 210, 211 area. Once we've gotten it, I mean, go back to that IWM chart. I mean, once we got it, it's been straight up. And I didn't give you the pre-market, but right now I'll give you that. Diamond's up 0.4%. Spider up 0.2%. QQQ up 0.25%. IWM up 1%. So IWM again, right out of the gates, leading again to the upside. The KRE is up 1.14%. And then the other part of the IWM to watch closely is the biotechs. And look what the biotechs are doing. They have not reached the high that we saw back in February, March, but this has been a pretty nice advance here over the past 5 or 6 trading days. So big break in terms of the trend line. I see the XBI going up, challenging and ultimately breaking out. And the KRE already has made the breakout above the highs that we saw back in last December and tacking on more at 54.22 in pre-market action. So really, really good action in that small cap arena and in the areas that lead small caps. So that's why, you know, things are going up. Transports. Let's talk about the transports because again, that, you know, if you've got a trouble with long-term memory and you only have short-term memory in the market, you think transports, you know, they're dead in the water. They can't do anything, right? Well, apparently they can, because last 4 days we've seen a big move up, not only taking out the recent highs around 15.4, but actually moving back above the highs set in April, or back in May. So now we've got transports moving. Now, I want to show you something on this transport chart. So let me pull up correlation with the S&P 500, and we're going to go back, 15 years. I'll go to a weekly chart. And I want you to look at the correlation down here at the bottom. Do you see how the correlation throughout history, for the last 15 years, has mostly been up at 1 or very close to 1, meaning that transports and the S&P 500 go hand in hand? But if you look back over these 15 years, you can see maybe about 5 times when we've had inverse correlation. Recently was one of those times. S&P's been going up and transports can't get out of their own way. But this isn't the norm. This is the exception to the norm. And that's what I've been, trying to communicate, that eventually we're going to see the transports jump back in. And obviously, with the market sending the Fed the signal that, hey, you have to lower rates, it's time. Well, guess what lowering rates does? It normally will help spur the economy, which means more transports, more goods being shipped. And as a result, money is rotating into this group ahead of the numbers that we're going to see 6 to 9 months from now. Because once we start lowering rates, it's not going to really hit until down the road. But the stock market doesn't wait to get those great reports. The stock market, Wall Street, starts to get in before it ever happens. And then we, collectively, all the retail traders, are left once we've had the breakout. Already I've had folks write into me and say, is it too late to jump into small caps, into the biotechs, the banks, transports? And my answer is no. I think they're just getting started. So, we were watching these key levels for a reason. And just because they break out and we go up for 4 days, I don't think this is over. I think it's just getting started. One of my predictions earlier this year was I thought small caps were going to crush large caps this year. Now, a lot of that came on the belief that rates would be cut earlier in the year than what, we're actually seeing. And so we'll see. But I think we're just starting. Just my opinion. I could be wrong. Anyway, let's take a look. Well, first, I'll take you over to Earnings Beats for the chart of the day. Make sure you go over to Earnings Beats. You can sign up. We have a paid service, but you can get 30 days for free. Start your no-cost trial. That'll give you 30 days for free, and you can kick the tires of everything we have to offer. We also have an event coming up on Saturday, July 27th, taking a look at why the Fed needs to cut rates. I'm going to show you economic reports in addition to the stock market things that I'm showing you today, because there are a lot of economic reports that are starting to move in the direction. And when they start moving in this particular direction, they generally precede bad market action. And we're just starting to see it, which is why I think time is of the essence as far as cutting rates now. We will see. Anyway, that event's going to be 3 or 4 days before the Fed meeting. Timing is going to be awesome, but you need to be a member, but you can be a free member. You can always cancel before the end of your 30-day trial. Check our service out, number one, but especially, have that July 27th event on your calendar. It'll be 10 a.m. It's a Saturday. Probably spend an hour and a half going over some stuff technically, but I really want to take a look at some of these economic reports and explain to you why bad price action is going to follow if we don't change the course of what the Fed is doing now. Mark that on your calendar. Anyhow, one chart I wanted to show you real quick. This is how, we're getting a breakout in the IWM and in, some of the areas I showed you. I'll show you the XLF, the financial sector here in just a second. But here's AXON, and this is part of the defense industry. This is about a $22 billion defense company. So I'd call it more of a mid cap than a small cap. But look at the volume come in yesterday. So after a big move up, this stock has been going through consolidation now for the last 4 months. Some people look at that, again, if you have short-term memory, you look at it and say, oh, well, it's not performing with the stock market. This is a horrible stock. Stay away from it. I look at it and I say, well, it's kind of in pause mode, but this is a strong uptrend. I mean, we went from 190 to 320 in this stock in 4 or 5 months. What's bad about that? So we've been consolidating. That's good. Sideways consolidation. This is a continuation pattern that normally will follow the direction of the prior trend. Prior trend is up. So when I see a stock like this make a break, a short-term breakout, I begin to think we're heading for 330 and beyond. Now, it may not happen right away, but I like this volume starting to pick back up again. Excuse me. I like the last couple of months making this little breakout here. I think we're going to make a run for it and ultimately get that breakout. And when we do, I could see probably another 60 points or 90 points being added onto the stock. So I like AXON, but I just happened to stumble across this one today. The AD line, even though we were going down, the AD line was going up, which is telling me that there's accumulation taking place. And I think now that we're making this break, I wouldn't be surprised to see the AD line move to a new high. But let's take a look at a couple of charts before we wrap this up. I know it's 9:30. Got a couple of minutes here, though, just to give you a couple of stocks or a couple of sectors. Here's the XLF. So let's zero in. Top here, mostly going sideways last 3 or 4 months. This is while semiconductors and technology were doing their thing, right? Well, technology is slowing down because semiconductors are no longer doing their thing. And so you have to have rotation into other areas. Other areas have to start leading in a secular bull market. If they don't, it means money's coming out of the market. So eventually you're going to see weakness in technology and in particular semiconductors. And I think we're seeing some of that right now. But that money that's coming out of semiconductors has to find a home elsewhere instead of leaving the market. And that's what it's doing. It's rotating. It's finding a new home. That's completely different than semiconductors going down and everything else going down with it and a ton of cash being built up. That is not what's happening here. We're seeing other areas breaking out. Look at the XLF. Pretty simple. Breakout. How about the XLV? Not a great day yesterday, but gap up today. And look at these tops coming across here. Consolidating. These groups weren't performing well. So people are like, oh, financials. You don't want to be in financials. You don't want to be in healthcare. They haven't been keeping up. You want to be in semiconductors. No, semiconductors topped. Until they break out again, I think you should just set them to the side for a little while. Some might do well, some might not. Your leaders will probably continue to do better than some of the laggards. But in the meantime, look at these other areas that are breaking out. I showed you the XBI and the way that's starting to move. I showed you small caps, the IWM. I showed you the KRE. I showed you the XLF. I showed you here now the XLV. You've got industrials, which haven't broken out, but are on the verge. They're looking to break out. That looks pretty good to me. I mean, even something like XLP, consumer staples, isn't far from breaking out. You might say, well, that's horrible. We don't want staples to break out. Yes, we do. Who told you? I never said that I don't want staples to go up. I just don't want staples to be the leader. I don't want all the money rotating into defense. So on a relative basis, I don't want to see the XLP taking off and leading us for the next month or two. If we see that, that's another bad sign for the market. But I do want to see the XLP go higher. A rising tide lifts all boats. It doesn't lift all relative boats, but it lifts all absolute boats. Anyway, but these are just some of the areas. I mean, I could go on and on, but don't listen to your short-term memory that only recalls certain areas doing well and other areas not. I mean, now that we're getting a breakout in all these other areas, I don't know what the breadth folks are going to have to talk about, because all of a sudden the bad breadth is going to be great breadth and the market's still going to be at all-time highs, and then everything's going to be fine. But in the meantime, since the last bad breadth issue, I don't understand how you trade. I mean, if you wait for the breadth to get good, you've already missed out on a lot of the rally. I don't know. Call me crazy, but that is, breadth, equal weighted ETFs. I mean, everybody's got their own opinions. I can tell you those two carry almost no weight for me. I don't care about the breadth. It's all about market cap. The S&P is market cap weighted. The NASDAQ, market cap weighted. I mean, if high market cap stocks, the small few, if they start performing poorly, S&P is not going to go up. Is it going to make you feel better that the smaller ones are doing better when the overall market isn't, when the major indices aren't going higher? I don't know. Anyway, the reason those companies have the high market caps because they're great companies. They continue to grow. They employ more people. I would want those companies to continue doing well. Anyhow, that's it. Let's take a quick look at the market, see what's going on. Sorry for that head fake, Tyler. You can see everything green again. We do see the VIX up just slightly, 1313. It's up 0.01. But everything else is up. We've got small caps up full percentage point. Everything else, lagging. Dow showing a little bit of relative strength again. And if we look at those sectors, the way we opened today, actually we have communication services and consumer discretionary at the top, which is good. I actually talked about that a little bit last night. I like consumer discretionary going forward. I think some of the areas within consumer discretionary that have struggled, I think are coming back to life now, which is a good thing, which is also why I don't care if the XLP sets a new high, because XLY is outperforming it right now. The ratio has turned back up in those two areas. So that looks good. Meantime, you got technology down here, not going down, but just floundering, kind of like it's been doing of late. And if we draw down, look at what's on the bottom, down today. Semiconductors. Shocker? Shouldn't be. Anyhow, that's it for me. I'll be back tomorrow for our live trading room, which starts at 10 a.m. That's another benefit. If you try us out for 30 days, you're going to get our live trading room for the next 5 weeks for free, starting tomorrow. So please check us out. Come on in, find out what everyone else has found out, which is that we call the market pretty well. We've been doing it for quite a while. And, timing might not be perfect, but we're starting to see some of the things I talked about earlier this year come to fruition. Anyway, listen, everybody have a great rest of your day. Enjoy the rest of this week. Remember, options expiring later this week. We got the Fed coming up in a couple of weeks. We got Netflix coming out Thursday after the bell. We got American Express Friday before the bell. Earnings starting to pick up. This is an exciting time, but keep an eye on us, and we'll keep you posted as to what's going on in the market. Happy trading, everyone.